Joining us right now is billionaire investor and philanthropist David Rubenstein, who is Carlyle Group's co-founder and co-chairman. He's also got a new book that is due out in September. It's called How to Invest, Masters on the Craft. And David, it's great to see you this morning. Thank you for being here.
My pleasure, Becky. Thank you for having me.
Why don't we talk about inflation first? We do have CPI data coming this week. It is expected to be very hot. We've been looking at the hottest inflation number since all the way back to 1982. You start to hear about the potential for 7 rate hikes. First of all, is it warranted? And second of all, do you think it'll happen?
Well, this 7 rate hikes would be over this year and next year. Remember, in the 1970s, when I was in government, we had a different situation. Inflation was double-digit. The Fed funds rate went up to 20%. We're not looking at anything like that. The Fed today telegraphs what it does much better than the Fed did in the 1970s under Paul Volcker. It's a different world. I think the market is anticipating that when the FOMC meets in March, middle of March this year, it will increase Fed fund rates by about 25 basis points. 50 basis points is possible. It would depend on the data between now and March 15th or so. But I suspect anything less than 25 basis points, which is to say no rate increase, would be a big shock. Something more than 50 basis points would also be a big shock. But I suspect the Fed will move gingerly each time it meets, probably looking at a quarter-point basis point, 25 basis point increase each of the times that it meets this year. It meets another about 6 times this year. It meets 7 times overall. It's already met once. So 6 more times this year it could meet. I suspect it won't increase every one of those meetings, but probably will get something around 25 basis points in the March meeting.
Hey, David, no question that this is not what we saw in inflation in the 1970s. We're not looking at anything near that. But when you're talking about 7% increases on CPI, that is pretty significant, and it definitely has an impact. We were just talking earlier this morning about some comments made over in England about how they think workers should stop asking for raises and bosses should be a little more strict in handing out raises to try and cut this cycle of inflation and stop it in its tracks. But that seems a little crazy when you look at the price increases that consumers are dealing with right now, whether that be food, whether that be heat or gas to fill their cars at this point. Inflation is here, and it is having an impact, and people on the street feel it.
Inflation's here. It's not double-digit inflation. We think it's probably due more to things relating to COVID because the supply chain got disrupted. Manufacturers started moving things away from producing new products, and ultimately, when the market wanted these products, it wasn't able to produce them. So now the supply chain is coming back to a more normal situation. It may take another year before we get there. So I don't think we have the enormous wage increase that we had in the 1970s that produced inflation. Other things caused inflation in the 1970s as well. Oil price increases were gigantic as well. But right now, I think it's not, I hate to use the word transitory, because that word has probably been damaged a bit.
Yeah.
But I do think that it's likely that we'll get this under control. I don't think it's quite as systemic as we saw in the 1970s, but there's no doubt the Fed needs to do something. I think the Fed recognizes that.
Shepard Smith here. Thanks for watching CNBC on YouTube.